Think the crypto market is just about buying low and selling high? Think again. You're entering a battlefield where billion-dollar institutions, shadowy whales, and sophisticated algorithms are all fighting for the same thing: your money, or rather, made-up internet money as some people call it. Welcome to the SwapSpace channel. Today, we're not diving deep anywhere. Actually, we're staying way above surface level because today's topic is a scary one: market manipulations. But here's the thing: once you understand how this game really works, you can start playing it instead of being played by it.
You got straight played, homie.
Let me show you exactly how market manipulation works, with a perfect example. Elon Musk's Bitcoin tweets in May 2021. On May 12, 2021, Musk tweeted that Tesla would no longer accept Bitcoin payments due to environmental concerns. And within 24 hours, Bitcoin crashed from $56,000 to $46,000, a $10,000 drop, triggered by a single tweet.
This is manipulation of the market.
But here's what really happened behind the scenes. Large trading firms had algorithms monitoring Musk's Twitter account. The moment that tweet went live, automated systems began selling Bitcoin across multiple exchanges simultaneously. The real manipulation came next. As Bitcoin hit $46,000, it triggered a massive liquidation cascade. Over $2.3 billion in leveraged long positions got wiped out in a single day. But look at what happened immediately after. Bitcoin bounced back to $50,000 within 48 hours. Why? Because the same institutions that sold on the tweet were buying back during the liquidation cascade. They used Musk's tweet as cover to shake out retail traders and accumulate Bitcoin at lower prices. The environmental concern was just the excuse. The real goal was market manipulation. Now we move to see the most brutal liquidation in crypto history: TerraLuna's collapse in May 2022. Luna was trading at $85 on May 5th, 2022, but by May 12th, it was worth less than a cent. But this wasn't just a price crash. It was a carefully orchestrated attack that shows exactly how liquidations can destroy entire ecosystems. And here's how it unfolded. Large holders began selling USD, Terra's stablecoin, in massive quantities, causing it to lose its $1 peg. As USD dropped to 0.95, then to 90 cents, the Terra protocol automatically minted new Luna tokens to try and restore the peg.
Homie, the faucet won't stop leaking.
But this created a death spiral. More Luna tokens meant each one was worth less. As Luna's price dropped, it triggered liquidations of leveraged Luna positions across exchanges. Each liquidation created more selling pressure, which minted more Luna, which dropped the price further.
We could nosedive. We could death spiral.
The numbers were staggering. Luna's supply went from 300 million tokens to over 6.5 trillion tokens in just 1 week. And every leveraged long position got completely wiped out. Retail investors who bought Luna at $80 watched their investments become worthless in days.
And I lost my case money. I lost my tuition.
Now here's something that won't wipe you out: the SwapSpace channel giveaway. You can win $20 by just watching this video. To enter, like the video, comment what you think is the worst liquidation in crypto history, and subscribe to our channel for more. Good luck. Now let me show you a perfect example of whale manipulation using Dogecoin's wild ride in early 2021. On the 28th of January 2021, Dogecoin was trading at $0.007, and within 24 hours, it hit $0.08, more than a 1,000% gain. But this wasn't organic buying pressure, this was a coordinated whale operation. Here's exactly what happened. A group of large holders began accumulating Dogecoin quietly over several weeks, buying during low volume periods to avoid moving the price. Then they coordinated a social media campaign on Reddit and Twitter, promoting Dogecoin as the next Gamestop. As retail investors began buying, the whales used sophisticated order management to create the appearance of massive momentum. They started placing large buy orders just below the current price to create artificial support levels, and made small purchases repeatedly to paint green candles on the charts. And the manipulation peaked when Elon tweeted about Dogecoin. But here's the key detail most people missed. Blockchain analysis showed that several large wallets began selling massive amounts on Dogecoin within minutes of Musk's tweet, while retail investors were still buying.
Buy more stocks. Now.
Want to see how institutions really operate? Let's examine MicroStrategy's Bitcoin buying strategy, which is completely different to how retail investors think. When MicroStrategy announced their first Bitcoin purchase in August 2020, they didn't just market buy $250 million worth of Bitcoin. That would have moved the price dramatically and cost them millions in slippage.
All went according to plan.
Instead, they used a strategy called time-weighted average price execution. They spread their purchases across multiple exchanges over several weeks, buying small amounts during high-volume periods when their orders wouldn't impact the price. But here's the genius part. They announced their Bitcoin strategy before they finished accumulating, and this created sustained buying pressure from retail investors who wanted to follow the smart money, while MicroStrategy was still quietly accumulating at lower prices. Now let's examine how the Ronin bridge hack in March 2020 created massive trading opportunities for prepared investors. On March 23, 2022, news broke that hackers had stolen $600 million from the Ronin bridge, which supported the popular Axie Infinity game. The immediate market reaction was brutal. AXS, Axie Infinity's token, crashed from $48 to $31 in hours. But here's what smart traders noticed. The hack affected the bridge infrastructure, not the underlying game or token economics. Axie Infinity still had millions of active users and was generating revenue. Within 48 hours, as the market realized the hack didn't threaten Axie's core business, AXS recovered to $42. The pattern repeats constantly. Hack announced, panic selling, smart money buying, recovery as market realizes actual impact. The key is distinguishing between hacks that threaten fundamental value versus those that create temporary fear. We've made a video on some of the biggest bridge hacks in crypto history. Click the link above to check that out. The Gamestop squeeze in January 2021 provides a perfect case study in market psychology spillover effects. When GameStop exploded from $20 to $480, it created a meme stock mentality that immediately spilled into crypto. Retail investors high on GameStop gains began looking for their next squeeze opportunity in crypto markets. This led to coordinated pumps in Dogecoin, XRP, and other cheap cryptocurrencies. But the psychology was completely backwards. Instead of buying quality projects at reasonable prices, retail investors were chasing momentum in overvalued meme coins.
My plan's best for business.
Now let me show you exactly how to use these patterns to your advantage with specific examples.
Example?
When you see a major FUD event, like the China mining ban, don't panic sell. Instead, assess whether the threat is fundamental or temporary. If it's temporary, prepare to buy during maximum fear. When you see obvious whale manipulations like Dogecoin pump, don't chase the momentum. Instead, look for quality projects that are being ignored during the speculation frenzy. When major hacks are announced, wait 24 to 48 hours for the initial panic to subside. Then assess whether the hack threatens fundamental value or just creates temporary fear. Every example I've shown you today follows predictable patterns. Whales accumulate quietly, then pump with social media. Institutions get better prices than retail investors copying them. And now that you've seen exactly how it works, the question is, will you be the manipulator or the manipulated? Thanks for watching. If you enjoyed this video, hit the like button and subscribe for more. And as always, stay safe and stay curious.